Today I'm going to explain about budgeting, which is very important in a managerial accounting. So to take a number of decisions by the management. Now, what are the learning objective of today's topic is we need to understand the concept of budgets and budgeting, the difference between these two, and prepare each component budget of the master budget and develop budgeted financial statements from the component budgets of the master budget and understand the budgeting process and the role of beyond budgeting model. Now, what is the difference between planning and control? Planning here involves developing objective and preparing various budgets to achieve these objectives. So first of all, that we need to set some objective, and after then we need to prepare the budgets for that to accomplish and to achieve these objectives. So budget is a very important element in both the cases, like in planning as well as controlling. Now, what is control? So control means that involves the steps taken by management that attempts to ensure the objectives are attained, means whether the objective that we set in our mind, those objectives have been fulfilled or accomplished or not. So if we want to see whether this is achieved or not, that is known as controlling part. So budgeting and controlling both are very important. Now, if we talk about the advantages of budget, so there are different advantages of budgets. So first, when we talk about the advantage, think about the plan for future. So for the future, we plan it, we think about that. So how much will be the production, how much will be the labor? So we thinking processes start, and that helps, that becomes advantage, because beforehand, whatever that we are thinking for the future according to achieving our objectives, so that will be fulfilled if we have budgeted for that. Now we have defined goal and objective. If we talk about what are the different goals and objective, so it means we budget and define these two goals and objective that can serve as a benchmark for evaluating the subsequent performance. If we talk about uncover the potential bottleneck, so uncover the potential bottleneck means the budgeting the process which can be uncovered the potential bottleneck before they occur, before the problems that they arise. Then we try to minimize those problems, we try to manage those problems, because this is not real, but this is the potential. Whenever we talk about the budget, budget is not the actual thing, budget is what we have in our mind, but that can be based upon the previous research, that can be based upon the previous sales or productions in the organization. Means of allocating resources. Now, the budgeting process provides a means of allocating resources to those parts of the organization where they can be used most effectively. Now, next, if we talk about coordinate the activities. Budgets coordinate the activities of the entire organization by integrating the plans of its various parts. Communicating plans. Budgets communicate management's plan throughout the organization. Now, we have here the big picture, means master budget interrelationship. So if we talk about at the sales budget that we have at the top, if we think that we have a sale budget prepared, this much sale is required in this period, maybe a month or a quarter. Then for the sale, what is required for the sale? We need to make some advertisement. We need to do some expenditure related to the selling and administrative expenditures. We make that budget that we can see on the right hand side of this model, and those expenditures definitely we will put in the budgeted income statement on the expenditure side. And the sale, that also we receive some money, that will uh, also be calculated. Also we will put that figure on the credit side of the profit and loss account, or maybe income statement, in the form of sales uh, occurred during the period of time. Now we have types of firms. If we talk about the types of firm, we see that there are manufacturing and merchandising. So manufacturing and merchandising, the two type of the services that we have. The third may be the services. Now, if there is a merchandising, means related to the product, that we think in our organization how much finished goods that we are going to buy from the other suppliers, right? So that how much cash is required for that, instead of producing, instead of manufacturing. If we are going to buy something, so it means how much cash is required. This is the cash budget will explain. If the cash budget will be explained here, then how much cash we have in the balance sheet, how much cash will be at the end of the period, that also will put in the balance sheet. Now, if we talk about the closing stock, which is known as ending inventory budget. And ending inventory budgets can be in both in case of manufacturing as well as merchandising activities. So if we talk about the production budget, how much units that should be produced, but for that we need to have some production budget in the manufacturing unit. So production budget, once we have prepared this much of production is required for this particular time period, then we need to have some another budgets as well, which are interconnected and interdependent. So here the first one is a direct material budget, then direct labor budget we have, then overhead budget we have. The combination of all these things are also depends upon the production budget. So this is related to the production budget, right? So this is what we can see. So we can see here the master budget interrelationship model here. Now, if we talk about choosing the budget period, so choosing the budget period is also one of the important tasks. Operating budgets ordinary covers a 1 year period corresponding to the company's fiscal year. Many companies divide their annual budgets into 4 quarters. Maybe in the year 2016, quarter 1 means from the April, the January, February, March means January to March, then April, May, June, 3 months. July, August, September, October, November, and December is the Q4, which is known as quarter 4. So annual operating budgets may be divided into quarterly or monthly budgets. Now, if we talk about the zero-based budget, so zero-based budgeting is an alternative approach to the budgeting, and particularly used in the governmental and non-profit, means not-for-profit sectors. Managers are required to justify all budgeted expenditure, not just changes from the previous year. So the baseline is 0 rather than the last year budget. Now, master budget, how to create the master budget here? So master budget can be created. in the master budget, as we have discussed, the most important part is the sale budget, which include a schedule of expected cash collections. No doubt, when sale will be made, some of the money we will definitely collect on the same day. Some money that we will collect after 15 days or after a month. So that is what we are thinking. We are preparing for a budget. So production budget, if we talk about merchandise purchases budget, is based for a merchandising company. Direct material budget include a schedule of expected cash disbursement for raw material. How much cash is required for acquiring the raw material? Not required for the merchandising company. It's not required for the merchandising company, means the retail company in which the finished goods are purchased and sold. That is the merchandising company. Take an example of a Costco. So Costco is the merchandising wholesalers. They are not manufacturers. Manufacturers are different, right? So direct labor budget is also related to the manufacturing unit, production unit, not related to the merchandising or retail or wholesale companies. Manufacturing overhead budgets that will be prepared, and ending finished goods inventory budget will also be prepared. How much closing stock is required? A selling and administrative expenses budgets will be prepared. Cash flow or cash budget need to be prepared, and budgeted income statement and budgeted balance sheet both will be prepared for the particular period, maybe a quarter or a month. Now, if we talk about the sales budget, detailed schedule showing the expected sale for the coming period expressed in units, or it can be expressed in dollars as well. That is known as sales budget. So one example that I'm just putting here in front of you, let's say Royal Company is preparing a budget for the quarter ending June 30th. Here we have some figures in front of us. So budgeted sales for the next 5 months. Months mean like the April, May, June, July, and August. We have units. We have 20,000, 50,000, 30,000, 25,000, and 50,000 units in respective months from April to August. Now, if the selling price is $10, that is per unit, which is also given. Let's say the sale budgets, budgeted sale that we will say in the month of April, May, and June. I'm talking about the Q2. Q2 means the quarter two. So quarter two sales that I'm just going to have it here. So what should be done? $20,000 at the rate 10 per unit. So that will be $200,000. So, and $500,000 that will be for the next month sale. Then $300,000 that will be for the next to next, means the month of June's sales. Now look at this. We have here 2 plus 5 plus 3 is equal to 10, means 1 million. So $1 million sales, that is for the quarter two. Expected cash collection example. Now, for example, you are going to collect some money. If we talk about the money that you will be collecting in the same month, 70%. So 70% will be collected in the month of sale, and 25% collected in the month of following sales. Following sales means the next month sale. and 5% is uncollectible, means 5% that you have not collected. The March 31st, March is January, February, March. So if you talk about the March, so March is the closing stock of the quarter one, which is also given. That is a $30,000 that will be collected in full. This is given. Okay, now let's see. The money that we have received, right? So money that we have received in the month of April, that money is $30,000, which is already given. And $30,000 that we received at the beginning, at the starting of April. Now, as per the figures and percentage given, 70% you can see and 25%. So we have these 2%, 70% in the same period, means same month, and 25% collected in the month of the following sales. Now, April sale, if we are going to collect money, let's take an example that in the April month that we have the sale figures. So sales figure for the April month is $200,000. So $200,000 that we have, 70% of the $200 is $140,000. And if we talk about the 25% that we will collect, means 50%, $50,000 that will be collected in the next month, means the month of May. So if we make a total of all these, that we have a 30,000 for the quarter, means April, May, June quarter is a 30,000. For $140,000, that is the April month's sales that will be calculated, and 25% that will also be calculated here, and the total of these that will be the total cash collection for the quarter. Now, if we talk about here, what will be the total cash collection for the quarter? What will be the total cash collection for the quarter? This is the question. This is the question in front of you. We have these figures, right? So what you can do, you can write some of the figures. I'm just going to explain now. The first figure is the $20,000. I can show you, I'll go back and show you something. Okay, so now what you need to do, you can put on writing something, write all these 5 figures. Write all these 5 figures, 20,000, 50, 30, and 25, and 15,000 units. And multiply by 10, that will be reflecting like this for the first quarter. But I'm saying that you need to write all months till August on the paper. Then that will be very easy to understand. Okay, so now this part is covered. We have all these figures. Now, what is the answer of the first question that I have here? How much money means for the quarter? So collection for the quarter, total cash collection for the quarter, right? It's a 700, 220, 190, or 905. So you need to write on the paper accordingly, and after calculating all the figures. So we can see that we have sales of April, May, and June. And as per the data available with us, so this is the question, and answer of this question is D, $905,000. And we have April, May, and June data. So if we calculate this much of amount, like 30,140, and a $50,000 here, that is for 25%. So 25% of the 200. So 25% of 500, that will be here 125,000, and a 350, that will be according to the sales of like 50,000 unit at the rate of 10, 500,000 unit for the month of May. Then we have total calculate here. If we're going to calculate all these figures, so definitely we will find the right answer, right? So we have this information with us. So expected cash collections. So we have here expected cash collections, right? So April, May, and June. April, May, and June. 3 month sale. So this is the June month, $300,000. 70% of this will be calculated here. So as per this information, we have this data. Now, if we talk about the production budget, so sale budget is completed. Now we talk about the production budget. So production must be adequate to meet budgeted sales. So as I have discussed that the production should be as per the sales, projected sales, and provide for sufficient closing stock, means ending inventory. So we need to produce some of the article, and we need to know that this much should be the closing stock, this much should be the ending inventory. Now let's see. Uh, this thing, this is one of the formula. You can note it down on the paper. You need to write this one. So first that you need to write this format, that budgeted. It's not actual. This is the budgeted sales in unit. You can write in units. So for example, this unit, that is budgeted sales in units. Now in this, that you need to add desired ending inventory. So desired ending inventory, let's say budgeted sales unit is 1000 units, and desired ending inventory, that is, let's say 100 units. So 1100 units that we will calculate that we needed. So we needed means we need to produce. We need to produce 1100 units for this month, or maybe for this quarter. If we deduct, if there is a beginning inventory, let's say, like if it is a like 50 is the beginning inventory. So we have beginning inventory 50, then 1050, that will be the inventory required. That will be the inventory required. So this is one of the format for the production budget. So look at this, and we will calculate something based upon that format. So here Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in unit. So Royal Company wants ending inventory, means closing inventory. So this is the name of the organization, and want closing inventory should be equal to 20% of the budgeted sale. So budgeted sale, which is not an actual sale, right? So budgeted sale is the base point that I explained in units, first of all. So whatever the budgeted sale in units, 20% of that should be the ending, means closing stock, means ending inventory. On 31st of March, $4,000 units were on hand, right? So on hand, that is the closing stock already, which is given, but that will become the opening stock for the next one, right? So beginning inventory for the next one means $4,000 will be deducted. Okay, so let's see. What are the figures we have? We have number one, 20% of the budgeted sales input. Second thing that we have 4,000 units that we have the closing inventory. Closing inventory of what? Closing inventory for the month of March 31st. Okay, so see, we know that in the month of April, 20,000 units, 50,000 units, and 30,000 units that respectively we have for the month of April, May, June. And now 20% of something. So 20% of what? We know that the budgeted sales for the next month is 50,000. So 20% of the 50,000, that will be the ending inventory. That will be the ending inventory. So you can see the $50,000 unit, the 20% of this is a 10,000. We will calculate 30,000, and 4,000 is already we have this figure, beginning inventory. So required production is the 26,000. This is for the month of April. This is how we create budget. Now again 20%, 50,000, 20% of this is, and 30,000 we have it here. So 20% of 30,000, that will be calculated here. Let's see what happens. Okay, so we know that beginning inventory. So beginning inventory for the April, that will equal to the closing inventory for the previous month. So this was the closing inventory for the previous month. It will become the beginning inventory for this one. Okay, so this production is required. Now 30,000, 20% of this, that will be 6,000. Now what is the required production for May? 1, 2, 3, and 4. What is required production for the month of May? Now May is here, and this is that we need to calculate. On the basis of this, that you need to calculate this figure. So now I'm giving you some time, and try to calculate the required production in units. Okay, so we have these figures. So required production for the month of May, that would be 56,000. So how it is calculated? This is the calculation that we have done. So total that we need here. Now the 10,000 that will become here. That is the opening stock. Opening stock for the month of May, the closing stock for the month of April. So will be deducted, then $46,000. That is the required production, and total needed is 56,000. Right. In the same way, we will calculate the next figure. In the same way, we will calculate the next figure. We know that in the month of July, we have 25,000 units. 20% of 25,000, that will be 5,000. We are going to add it here, and 6,000 already that we have calculated. So 6,000 here, that will be deducted here in 29,000. So this 5,000 has come from the figure I can show you. You know, at the very beginning, we have one data. At the very beginning, that data was available, like this was the data, 25,000 units, month of July. So in the month of July, you'll see that how we have calculated. In the month of July, so this is June, in the month of July, we have 25,000, 20% of 25,000. Now it comes to 5,000 units will be added here in the budgeted sale. So total needed 35,000, right? And the opening beginning inventory will be deducted $29,000. I mean 29,000 units were required. This production is required. If we're going to make a total of April, May, and June, so the total will be here, this one, right? So total of this is here. That is the budgeted sale. Sale that we have done, sale this one, sale this one, sale this one, right? So total will be here. If you're saying that the why we have calculated 5,000 units. So 5,000 unit is if we say we know the formula. The formula saying we are going to add the desired ending inventory. So here the ending inventory is the 5,000. So we are going to add this ending inventory of the quarter ending. April, May, June, quarter ending is the 5,000. So 5,000 that we are going to add it. So once we have added this 5,000, 105,000 is the total units required here. Total needed in a quarter two. Then 4,000 is the beginning inventory. So beginning here is, this is the beginning. This is the ending. So beginning here is the 4,000. So 4,000 that was the beginning. So we have here deducted the beginning. So now what is 101,000? So 101,000 production is required for this quarter. Right. So this you can see it here. This comes to this one and this is coming to this way. Now, if we talk about the raw material needed to meet the production schedule, and this is the formula that exactly that we are doing for what we have done for the previous one. Like this is for the direct material budget format, and what we did for the another format. So that format was also available. So this format shows the production budget, right? So step by step, the one was the production budget that was based on the sale production budget. Now once the production budget is done, now we have the similar kind of formula here, which is known as direct material budget format. So direct material which is used in the production, that will be also calculated. So direct material. So direct material we have here raw material needed to meet the production schedule. Now raw material required. Now the base is production. For the production, the base was sale, right? So all these are interdependent activities, interdependent budgets. A raw material that needed to meet the production schedule, that we will write here. Add desired ending inventory of raw material, that is also required. Total material needed, this much, and less at the beginning inventory of the raw material to be purchased. It means this much of raw material should be purchased from the outsider suppliers, right? So this is the one of the formula, one of the format that we have for this. Now look at this, and this is one example in front of you. So what this example is saying, that at a Royal Company, 5 kilogram of material are required per unit of product, right? So raw material, 5 kilogram of material are required per unit of product, and management wants material on hand at the end of the each month equal to 10% of a following month's production. Okay, so this is the data available for us. Now, as per the data available, that we need to calculate something. So definitely, exactly the same way, we will calculate the material budget. This is the closing stock that we have, 13,000 kilograms of material are on hand, and material cost is 0.40 per kilogram. So we have some informations like in the dollar amount, we have in kilograms as well. Both things we have. Now, let's prepare the direct material budget. That will be calculated in the same way. So we have here, let's say, 26,000. So we know that we calculated 26,000, 46,000, 29,000, and the total was 101,000 quarterly production required. On the basis of this, that we are going to calculate direct material. So we know that 26,000 is a unit. Material per unit is also available, that is a $5, right? If we multiply this one, that comes to 130,000, 230, 140, and total is $505,000. So now we have all these figures with us. As per the information which is given, like now we want to add desired ending inventory. So desired ending inventory is based upon the future production need. So desired ending inventory, that is 10%, which you can see once again, 10% of the following month production. So 10% of the following month production is here, 23,000. Here should be 23,000. So when we calculate these two, it will come to 153,000 here. So now we have calculated 10% of this, and 153,000 is the total needed, right? So 10% of the following month's production that we have here. Now we know that there was something like beginning of the inventory. So less beginning. If something is beginning, there will be some closing of the quarter. So the 30, so how, from where that figure will come? What we can see, go back and see once again if we have something there. Okay, so we have calculated all the figures till June. If we would like to calculate for the month of again maybe next quarter, that we have some data. So on the basis of that, we will be able to calculate the beginning inventory, right? So the beginning inventory that will be here, 13,000. Okay, so March 31st of inventory, March 31st inventory that is available, that is a 13,000. So that is deducted, and 140,000 is the material to be purchased. Now we need to calculate. We need to calculate this figure. We need to calculate this figure. So how to calculate this figure? We have different options available. So what is the right option according to you? You need to see what is the right option according to you. You need to calculate. You need to calculate. Okay, so I am giving some time to all of you. So take a little time based upon the information available. You can write on the paper and try to calculate. So these are the four options. Yeah. So we have this information 13,000 at the beginning of the period, right? So which is already given in the question, and we subtracted 140 that we have units over here. So next here is that we need to calculate some figures over here, then here. So how to calculate this figure? Like 10% of the next month production needed. 10% of that we will be going to calculate here. That will be added, and after then we are going to subtract the opening stock. That will become the closing stock of the previous year will become the opening stock for the next month, and that is May. So according to this, the answer is the A, 221,500 kilograms. So this is that we are doing budgeting. Look at this, the solution is here, how that we have calculated. So we have calculated on the basis of like the 23,000, that is the closing stock will become the opening stock for the next one. This closing stock become the opening stock for the next one. This is the closing stock that definitely that will become the opening stock for the next one. So from where it has come, and from where it has come, that we need to see, right? So it has come from here 10%, it has come from here, and 11,500 has come from the July. So the July sale. So from the July it has come this figure, right? So 10% of the July is the production needed. So we need to fill April, May, June, the full quarter that we are going to add it. So this we have added, this is the rate. So as per the rate, we have calculated 505,000. Then we see that we have April, May, and June, the closing stock here, ending inventory for the quarter ending, that we were going to add it here. And beginning, that exactly the same thing that we did for the production budget, exactly the same thing that we are doing here for the direct material budget example. Okay, so next part we have here the distribution system. So here we are going to calculate the direct material, and specifically if we talk about the expected cash disbursement for a material. So cash disbursement for the material means, so we are going to divide that materials like in the month of April, in the month of May, in the month of June. What should be the right amount for the total cash disbursement, right? So in this case, total cash will be required for buying the material, which is also very important. So in this case, we know that Royal pays 40 cent per kilos, right? So 40 cent per kilos for its material. If they want to buy this particular kind of material, then the cost of the material they have to pay. So cost is 0.40 per kilo, right? And half of the month's purchase are paid for in the month's purchase, right? and the other half is paid in the following month. Means uh, half that will be for this month and half that will be paid in the next month. Definitely we will pay some money. This is just like the sale that we calculated, just like the purchase that we are going to calculate it. We are budgeting our purchase. If we know this much of a kilogram that we need, definitely for per kilogram there will be some amount that is already that we know. This is the cost that we got. Maybe that we know this from the previous data from or maybe that we can know from the supplier, and we know that this is the cost per kilogram. The 0.40 per kilogram is the cost that a royal company will pay for its material to the suppliers. So from that half means the 50%. 50% of the month purchase, the total month purchase, let's say $100,000, that will be paid in the month of the purchase, mean in the that particular month, and the rest 50% money will be paid in the next month, mean the following month. We know that we have some dollar amount at the end of the period, end of the March, means the previous month payment. We know this is account payable. Account payable is the money that owed to the supplier, to the outsiders. Money which we have not paid to the supplier in the last month will be paid this month. And this is that will become the opening balance for this month, that amount. Okay, so let's go further. We see that we have some data in front of us. We know that account payable for the last month is 12,000. That will become here the balance. Like this is the balance of which we have here, right? So this is the total dollar amount. Now we need to calculate. We need to calculate this some kilograms, right? How many kilograms that we have? We need to see. Let's see how many kilograms we have. We have here 140 kilograms. So material per unit is this much, and then we need to know about this much of material is required, because this is the amount. This is amount. Then this much of this is 5 per kilograms. In 1 unit, and the if we weight that unit, that is the 5 kilogram. So this figure is in kilograms, not in dollars. So 140,000 kilograms, that is uh, required in the month of April. Now we know that 0.40 per kilogram that we pay. It means if we say that 140,000 kilograms multiply 40 cent, mean $56,000 that we will pay, 50% this month and 50% next month. This is given in the question. Now what is required? What is required? So in the next exactly the same way that you need to calculate all these figures. So this is the question in front of you. What are the total cash disbursement for the quarter, right? So you need to calculate which is the right amount. So these are the amount, you can note it down on the paper, and on the basis of this, the information available, on the basis of the information available, you need to calculate, fill this much of amount. Like April data is here, now May data. How many kilograms are there? Go back and see how many kilograms. You will see that like 221, then 500 kilograms that you have. So on the basis of this, you will multiply with the 0.4, then something will come, right? So accordingly, that you will see how much is required, right? So how many it converted into dollars that you need to calculate. Okay, so this is the information. We have this information, and this is the question in front of you. So you need to calculate all this information and what is the total amount disbursement for this quarter. Okay, so now I can see that the answer for this that will be $185,000, right? So this is for the direct material cost. That will be the quarterly that we will calculate. So look at this, we have exactly the same figures. 50% of this amount that we have calculated exactly the same way that we calculated this one, right? So this is the data available. So $185,000, that will be the cash disbursement for materials here. Okay, so for now that I think like today is enough for the day, because that we have done a lot of calculation, right? So next we will continue with the direct labor cost. But the base will be this one. So as I discussed at the beginning, that all this information is interconnected. All these budgets are interconnected. When one is over, it is depending upon the another one, right? Starting from the sale, then production, then direct material, then that will be the direct labor. Then maybe there may be some overheads, right? So all these budgets that we need to prepare. So this is the managerial accounting that we are doing. And today's topic was budgeting, right? So how we can prepare budgets.